Now, when we talk about funds, generally we talk about blind pool, meaning I don't know what I'm going to buy, but I'm going to build the box. And I want to relate this back to the roll-ups because I know there's so many roll-up opportunities that are going around everywhere. But when we talk about a fund, it is to buy multiple pieces of real estate that we can't identify yet. We're going to invest into multiple private companies that we can't identify yet. We're going to have a stock trading mutual fund. It's an equity fund. We don't know what we're going to be buying. With a roll-up business, we generally don't know what we're going to be buying. So I would say from a general perspective, a roll-up is an equity fund because we don't know all the targets. However, for you to raise the capital faster, easier, and, well, building that audience effectively, saying not just we're going to buy HVAC businesses across America, but saying we're going to buy this particular HVAC company in Phoenix, Arizona, and then we're going to continue to buy additional HVAC companies that are meeting these same targeted criteria, you'll just get a lot farther with the discussions, and it's a better way to raise the capital. But to move on to what the structures actually look like, and
This
I know
familiar.
except for the biggest difference of, thank you, Richard, for being so unbelievably helpful with this. But I will also say that he loves to have all the animations and everything else. And I'm like, just throw it out there. It's a same structure. It's doing the same thing as a syndication, except for one big thing is we have no clue what we're going to be buying. But in terms of thinking about like management fees, distributions, what the investor receives, what rights they have, at the end of the day, it is very, very similar to that syndication structure that Richard just went deep kind of describing, except again, we're just defining this targeted box. And it's about that easy. There are some other considerations that go along with this, though. So if you have any questions about the structure, let me know. But the other considerations are, well, to start with, and we don't have a slide on this, but I'll bring it up anyways, the Investment Advisor Act of 1940 and this Investor Company Act of 1940. If you start an equity fund, you're investing into other securities like a mutual fund, or even if they're pre-IPO, you have to figure out if you're acting as an investment advisor. But as long as you're not doing more than $20 million at first, there's exemptions. You may have to start registering as a exempt reporting advisor, which is some filings with the SEC. We can absolutely help you with that if it ever becomes an issue. But when you're just getting started, it's not the biggest issue to be concerned about. However, the Investment Company Act of 1940 is very important. And it's very important to avoid entirely. There's just a lot. You're basically going public with all of the audited financials, quarterly reporting, and other reporting requirements that have to go to the SEC. So we want to stay away from ever doing an investment company that is not excluded or exempt. And there's 100 different ways to do it, with the major exemptions from the Investment Company Act being that you only have less than 100 investors. So as long as you're doing small funds, it doesn't really matter. Or if you're doing a primarily real estate fund, you're exempt from the Investment Company Act, or you're only working with the institutional investors, somebody that has assets of $5 million or greater.
Not just a big house. $5 million in their portfolio, then they become qualified purchaser.
C'est la vie. We're okay with that. But that's kind of the biggest issues that we do consider when we're talking about the Investment Company Act. Richard, do we have any questions that are kind of dealing with funds to go?
What about a fund with the purpose of purchasing shares of operating companies in the commercial maintenance industry and in debt portfolio notes backed by the portfolio? This would be a $30 million fund, ongoing 120-day call on individual investors' investment. Very specific.
Very doable. Other than the $30 million fund is you have to figure out an exemption. One exemption that I did not speak of, but will fit this most likely, as long as you are taking majority ownership of the acquisition targets. Going back to the roll-up strategy, one way that the roll-ups are not investment company issues is as long as you're buying at least 51% of the voting and control interests, a majority of every one of the companies, then it is exempt from the Investment Company Act. So that's also where, even if we call it a HVAC fund, we're not getting stuck with Investment Company Act issues as long as we're taking that majority interest. Whether or not it's an investment advisor issue, that's a different consideration, but generally you don't have a concern there. With that example of raising $30 million to buy the debt or equity, as long as you're getting 100% of the secured lien debt interest, there is some limitations or risks there based on the Investment Company Act. But if you're acquiring the stock, again, just make sure you're getting 51% of that stock.
Does it make sense to do a $100 million fund with specific criteria for what you want to invest in for multifamily versus doing a bunch of $5 to $10 million funds?
Well, I can tell you that you don't want too big of a fund that you are ever capitalizing. At the end of the day, it is based on the size of your network, of your audience. But I like to set up funds where you're expecting, based on kind of the investors in front of you or that you believe that you can have, that you can really get it fully funded in 6 to 9 months. If you're thinking $100 million and it's going to take me a few years to do it, for God's sake, don't do it. There is always the issue of, why invest today when I can wait to invest 6 months from now or a year from now, so I can see how you're doing managing this fund? And that is one of the big difficulties in actually managing or raising capital for a fund, that oftentimes it's not there for the syndication. With the syndication, you have a closing date. Funds have to be in by this particular date or you've missed out. With the fund, it's a little different from that. The big motivators are if you can offer some early investor incentives. First $1 million gets some additional benefit. Great, you do that. Or if you're just getting into it or you haven't done a whole bunch of syndications in the past, I would rather do a $5 million fund while still reserving the right to increase it. And then just keep increasing it by $5 million at a time. And then you can cut it off at any time, but you always have the act now, get in quick, because you know what? We may not extend later on.
Another way of doing it, and this is what a lot of people do, they start with a fund that kind of turns into a syndication. So they have a fund, they start raising money. At some point, that fund identifies the one property they're going to buy. And from that point on, it kind of works like a syndication. So then they'll do an incentive. So maybe we're going to split profits 80-20 with the investors, but you get a 90-10 split as an investor if you invest before we identify the property. So that's another way you could do it. And then you would just cut off your fund, once you identify the property, you know exactly how much you got to raise. And then you can cap your fund at that point and then roll and do the next one after that deal closes.